So if you threw a dart at a board in the last 5 years and went into any real estate investment, chances are you did phenomenally well. And we may be at a period or a point here where, really based on the actions of the Federal Reserve and the increase in interest rates, where right now it's looking like the Fed rate is going to end up over 5%. Um, and that's going to take mortgage rates to over 7%. So we may be at a point where you're not going to be able to just pick up any piece of real estate or make any real estate investment and generate the return that you want. However, historically, real estate for a lot of reasons has been kind of the second go-to after public equities for investor, because if you want to generate growth or income or a combination of the two, it provides that, also provides some great tax benefits, and also historically has been a really good hedge against inflation. So if you're looking to pick your spots in real estate, e-commerce or industrial space may be a segment of the market that's attractive right now. So when you look at 2022 e-commerce sales, they were about $904 billion. And the consensus projection is that by 2027, that number is going to increase to about $1.7 trillion. So these e-commerce giants, they typically don't own their real estate. They're generally renting them from various funds or owners, and that's what I'm going to show you today. And when you look at just the performance alone in industrial real estate last year, it was about 3 times the average real estate return at 23%. Of course, we were coming to the last inning of COVID-19, so hospitality was down about 8.3%. Retail, of course, down, which that's going to suffer as e-commerce increases. Multifamily is unique. We believe it's likely that multifamily will continue to do moderately well, really for the reason of the increase in interest rates. So a lot of families who are currently renting, let's say they were planning on purchasing a property next year or in 6 months or in a year and a half. Well, what's happened is with the increase in rates, their buying power has been pretty significantly eroded. So everything just got much more expensive for them. So there's a good chance that a lot of those potential buyers are going to put off that purchase and continue renting, which is going to keep the rent supply low and, of course, cause rents to increase. Office space is not particularly attractive, but here we have industrial. So industrial could be anything, but you want to focus on e-commerce because the majority of businesses that are renting out warehouses are doing some sort of online sales. Now I'm going to show you on the next screen. This is taken from Blackstone BREIT, which BREIT is really Blackstone's, I would call it their flagship fund. It's a little over $60 billion in real estate right now. And the reason it may be attractive is because 25% of the real estate in this fund is, in fact, industrial space. So Blackstone's biggest tenants are companies like Amazon or Shopify or Overstock.com. And you can see on this far right graphic, rent growth has continued to increase really significantly, almost like a hockey stick in the last couple of years. And vacancy has continued to tighten. Now, this would be considered a private REIT. The other alternative would be a publicly traded REIT that has a concentration or solely moving in the industrial real estate space. Also, this portfolio, 50% is in multifamily residential. So this doesn't exactly accomplish a concentrated investment in e-commerce, but it gives you a piece of the pie. Another way to approach it would be through real estate syndication. So typically you're going to see syndications in multifamily residential properties. From time to time, you will see them in industrials like this Alpine Industrial Park. This is one that we're using right now. Now, I mentioned at the beginning, we may be coming to a time where you can't really just throw a dart at the board and your real estate investment is going to go up. So a fund like Blackstone that we were looking at before, you're really counting on them to be targeting the right geographical area, the right demographic in that area, buying those properties right, possibly increasing rents, so using short-term leases, buying quality real estate. But to some extent, you're kind of counting on the tides of the real estate market to generate the growth component of that return. Syndication is a little bit different because if you invest in a syndication, they're targeting that specific property because they've identified it through their studies as being a property that they can purchase, actively manage it, and do a value add, which is really key to the growth component. So, and then they want to sell that property, usually in a time period of 3, 4, or 5 years. So you're typically going to see a higher target IRR in a syndication because of that actively managed value add. You do generate the income, you get the same tax benefits as really any other real estate investment through depreciating the assets, but the goal is a higher capital gain on the back end. One of the negatives in a syndication like this is certainly going to be liquidity. You really have extremely limited, pretty much no liquidity in a syndication until that syndicator decides that they found the right deal for the limited partners or the investors or you, and they go ahead and sell that property and create that capital gain or liquidity event on the back end. So this one has a target IRR of 14.7. Of course, you know, if you look back in the past couple of years, they far outpaced these target IRRs. Some of these might get into the line over the next couple of years and be more consistent with their goals. The liquidity event, they're looking for a 3-year hold. Of course, it certainly could be longer than that. So it's something you have to consider as an investor, that you may not be able to get out of this investment for 3, 4, 5, you know, possibly even 6 years if we come across some roadblocks in the real estate sector or the economy as a whole. But certainly, real estate still plays a part in an overall portfolio for a lot of the reasons I mentioned at the beginning of this video. But you need to pick and choose our spots here. And we think industrial, e-commerce, and a little bit of multifamily residential is the place to go. So I hope that you found this somewhat helpful. If you want more information on specific industrial real estate investments or syndications, you're always free to reach out to me. My name's Andrew at Jesani Wealth Management, and I can be reached at 954-800-8552. Okay, thank you. Take care.